some money on their policies and all that fun stuff. We're about to get this stuff kicked off tonight. People that will join us as they come. But if not, we're gonna hit chapter 4 pretty on their policies and we're gonna hit chapter 4 pretty hard tonight. Good thing about tonight is that it will go by fast. It's gonna be a lot of writing, but we're going to make it go by pretty fast tonight. So hope you have some your hands ready to write or type, whatever you're doing. So tonight we're going to cover chapter 3. Good to see you. Good to see you all. Again, I encourage you, please. Thank you for keeping your cameras on. It gives us the feedback, kind of shows us who is with us tonight. All right, so we're going to talk about chapter 4. So chapter 4 tonight is a lot of definitions. A lot of definitions, okay? So it's going to be a lot of writing tonight, Gia. Camille, good to see you too.
Me too.
All right, so chapter 4, we're going to talk about retirement plans that are either qualified or non-qualified. We're going to cover group insurance, Social Security, and all the other fun things about how policies work. So, terminology that we're going to talk about. I want you to write the word earned income. Earned income, these are based off of salaries, commissions, wages, money that you make from doing either labor work or you have to go earn yourself, not like investment income. Uh, Gia, you'll see the word first in, first out. We're going to come back to that. So we're just remember that. We'll come back to it. What is gross income? Income is someone's income that they earn before taxes. Do you know why they call it gross income? Because it's gross, not enough. Not enough money. All right. What is LIFO? Last in, first out. I talked about that during the annuities of how the money is taxed based off of when you pull your money out. We're going to go into we'll go into more detail with this as we go. Nonprofit organization. It's an organization that uses surplus to fulfill its purposes instead of distributing. What's the commission for an affiliate to the affiliate? Um, so the nonprofit organization is obviously I think we all know what a nonprofit organization is. It's an organization that is going to do good things, hopefully, with your money. I say hopefully because have you ever heard stories about the Red Cross or companies like that? CEO takes most of the money. Don't know if it's true, but hear stuff like that. Policy endowment. Another word for that is policy maturity. That is a policy maturity. Remember, that is going to come more into whole life policies, right? Pre-tax contribution. That's going to come into retirement accounts. This is contributions that's made before federal and state taxes are deducted. So let's talk about rollover. Rollover. This is when you withdraw money from one qualified account and move it to another plan. An example of a rollover is if you have a 401k at your job, you leave your job, you roll that money over into a new account outside of the job. Like if you guys have any money sitting in any old 401ks, don't keep it at your job. Roll it over to your new IRA or into your new 401k at your job. Surrender. Early termination. This is when you cancel your policy. As simple as that. Vesting. Vesting is the right of participation in a retirement account. If you guys have ever had a job and you had a 401k, they have what are called vested rights or vesting time periods. So if they're matching your accounts, you have to work for the company for a certain amount of time in order for you to keep all the vested money put into it. Tax deductible. This is reduction of taxable income, which will result in lower tax liability. Well, again, we'll cover more about that into later in the topic of retirement accounts. Taxable subjects to taxation. Pretty straightforward. Tax deferred. This is when you invest money into an account and it will continue to grow and you will not pay taxes until you withdraw it at a later date. If you did not catch all this, again, we're going to cover a lot of this in the chapters. These are just kind of terminologies we're going to need to know. All right. Let's talk about the first part of this, third-party ownership. What is third-party ownership? This is when most insurance policies are written where the insured and the policy owner is the same person. However, there are situations where the contract may be owned by someone else. These types of policies are called third-party ownership. We kind of covered that on chapter 2, where if you own a policy on your spouse, or you own a policy on your kids, or if your job owns a policy on you, or if you own a policy on your business owner, you're technically a third-party owner because you're not the insured. You're the policy owner, but you're not the insured. That's pretty straightforward in that situation. Okay, so thank you, Gia, for letting us know that. I'll make sure we go through that. So let's talk about life settlements. So life settlement is a term which in financial transactions, which the owner of a life insurance policy sells the policy to a third party in some form of compensation, usually cash. So if you remember in the chapter, I think it was chapter 3 yesterday, we talked about assignment. Assignment was a transfer of ownership. When you enter what is called a life settlement, Camille, you are selling your policy to a third-party company. We're going to more detail of when that comes into place here in a little bit, because there's situations where it happens. Okay, the term business of life settlement refers to any activity relating to solicitation, sale of a life settlement contract to a third party who has no insurable interest. So there are companies out there that actually look for policies for people to buy. They will actually buy your policy for a lower amount of coverage. I'm sorry, for a percentage of the face amount. And then when you die, they're going to collect them the money. It has to be a certain situation in order for you to do that, though. Okay. The things that they're going to look at is the insured. Is the person covered under the policy considered at sale for the life settlement? They're not going to go buy a policy for someone that's healthy. They're looking for someone that's on their way out, right? So they're going to take into account, Camille, the life expectancy of this person. It refers to the calculation based off on the average number of months the insured's lived, or insured's projected to live due to medical history or mortality factors. So again, Gia, they're looking for people who are having health issues. Maybe you're terminally ill and they said, hey, listen, maybe you need some money. And they say, okay, hey, listen, if you need some money, so they are looking at that situation. And if something happens, how do they bank on it? So life settlement contracts establishes the terms in which the life settlement provider will pay compensation to the policy owner. In return, the assignment, which is transfer of ownership, will be given to that person. Now, there's someone called a life settlement broker. It's a person who, for compensation, negotiates contracts for life settlements. You imagine being that person? They're like, hey, you need this money, right? You're about to die. How about we give you some money right now and you just sign this contract over to us? That's how I picture it. I'm pretty sure this is probably a lot neater than that, but that's how I picture that. Life settlement provider is a person other than the owner who enters the life settlement contract. So this is the person buying the policy. The broker finds the deals. The life settlement provider is the one buying the deal from the insured. You with me on this? I think we're pretty good. Okay.
Okay,
All
so
right.
the broker is the middleman.
Correct. The broker is the one looking for the deals. The provider says, "Hey, go find me the deals." They find them. I'm pretty. Well, imagine if it was like Tinder. They just keep swiping through medical records, but nah, this one's not it. This one's not it. Yeah, oh, let's go for that one. I know, right? You just give me all the judgment looks when I said that. You're like, golly. All right, let's talk about group insurance. So let me give you the bullet points of group insurance. Okay. So if you want to write group insurance, it's life insurance owned by your employer. It's paid for by your employer. The type of insurance that they provide is known as ART, annually renewable term. So every year when your benefits come up, your premium's going up. Remember, the job owns the policy. Most of the time, they're paying for the policy, and the coverage amount that they offer, or the coverage type that they offer, is annually renewable term. What do we remember about annually renewable term? It renews every year, price goes up, no evidence of insurability is required. So there's no time you have to go through medical exams. In order to get into a group policy, you most of the time have to enroll in the period of time called open enrollment, right? You guys have a corporate job, you kind of hear about open enrollment benefits coming around. October is generally that time. During open enrollment time, as long as you apply during that time, you don't have to do a medical exam or provide evidence of insurability to get covered. They'll just automatically cover you. But if you enroll outside of the open enrollment period, you may be required to provide proof of insurability. The other thing you want to know, I hope you're writing this as I'm telling you this. So the insured of a policy receives a certificate of insurance. So if someone says, I have life insurance at my job, and you say, okay, well, show me your policy. They don't have a policy. They have a certificate that says, hey, I'm covered for X amount. So, as the employee, you don't have control over it. If the job says, hey, listen, benefits are cut right now, you can't decide whether you go with them or not. No, it's just if they cut the benefits, they cut it. So who actually owns the policy? The employer. They own what is called the master policy or master contract. So the master policy or master contract um, is what you're going to do. What are you doing afterwards? So look at it this way. If you enroll during your job, the insurance company's mindset is they want a high turnover rate in the job. They want a lot of younger people coming in and older people leaving. That's the mindset. Why? Because statistically, the older you get, someone's going to pay out, right? And the purpose of the group is this. No company can go form a group business for the sole purpose of buying life insurance. So you might see on the exam, which of the following answers is incorrect or something about group insurance. If it says if the group was formed for the sole purpose of insurance, you can't do that. That's just an easy question that you might see. So when insurance companies are putting together the policies, they are looking at the size of the group. It's something called the law of large numbers. They know statistically, the larger the group of people, the more accurate their projections of future loss experience will be. You have a pool of more people, kind of figured something's going to happen, and things are predictable. When you are getting a policy set up for a company, they look at the financial strength of the group. Because group insurance is costly to the administer, the underwriter should consider whether or not the group has the financial resources to pay the premiums, or whether or not it will be able to renew the coverage. So if an insurance company comes in there and forms a policy for your group, it's expensive to them. So they're going to look at, is this group responsible? Are they financially doing well? And I'm not sure if you know this, if your job offers you benefits, it's not only because they like you, it's because it's a tax deduction for them. The more benefits they offer you, the less income they're paying. They can wipe that off of their tax bill. So they say, well, we'd rather give it to our employees versus give it to the government, right? Okay. Conversion privileges. If you've ever had a policy at your job, most of the time when you leave your job, that coverage doesn't go with you. For the sake of the exam, they have the mentality of that it can go with you. Okay. So this is what you want to write about group insurance conversion privileges. You can convert the policy to an individual one within 31 days of leaving the job. When you leave the job, your premium is going to go up based off of your new age. Your premium is going to go up because guess what? The employer's not, or your payment's going to go up because the employer is no longer paying it, right? You're converting to an individual policy. And you can only convert to a permanent policy. You cannot convert to a term. So when you leave your job, your policy is going to convert to a permanent policy. All right. Any questions on that? Okay. So that's conversion privileges about group insurance. Okay. Last thing we're going to talk about is non-contributory versus contributory. So the employer-sponsored plans pay all the premiums and share the premiums with employees. Pay all the premiums or they share the employee premiums with employees. When an employer pays all the premiums, you want to write that down. Non-contributory is when the employer pays all the benefits. So when you look at that, you say, okay, well, why would they pay that? Well, they want group. That's a good culture to have within a group, right? Group insurance and benefits is actually a benefit to the employee. They said, okay, well, what if I can't even get insured by a policy outside my job? At least having group insurance is better than nothing. You know, out of all my time in business, I've only seen one group policy pay out.
Yep, that's about right.
Not saying that the other ones haven't. No, that's not true. I seen I had a truck driver that got into a bad accident, two of those, and their work policies paid out. But that was a freak accident. Um, Under non-contributory plans, the insurer requires 100% eligibility. So write that in. They want an 100% eligibility to be included in the plan. Okay.
Miguel, would that be the same for business owners, small business owners, if they did a group policy for the ownership and their staff?
For sure. Yeah. I mean, that's exactly what
Okay,
that is. Yeah. That's exactly what that is.
got
Uh,
it.
okay. So contributory is when the employees and the employer share the cost. So it's group insurance for contributory is when the employer and the employees share the cost. So under a contributory plan, insurers require 75%. So somehow remember contributory, 75% contributions, non-contributory, 100%. You will see this on the exam. Okay. All right. Any questions on this? Nope. Okay. You see, we're already almost halfway through it already tonight, guys. Tonight's gonna move pretty fast. This one right here. Okay, we're gonna take our time on this. If you have access to a printer, I do recommend you print this stuff out. Okay. I'm gonna explain what this means in detail, but I want to help you kind of get the mindset of it. Okay. So qualified plans are your plans that are approved by the IRS. They're generally employer sponsored plans. The way employer sponsored plans is your money is always going to be tax deferred, which means like your 401k, your 403bs, your TSAs, your TSPs. These are accounts that your employer sets up. They match you. You don't even see the money on your check. They pull the money out before it even gets to you, right? So you invest that money over 30, 40 years. It's going to grow, but because the money is tax deferred, you're going to pay taxes on that money upon withdrawal at the future rate, at the older age. Um, let's kind of go through the procedures and the things that people would want to get for a qualified plan. So qualified plans are always approved by the IRS. Qualified plans have vesting requirements. So sometimes some employers will require a 5-year vesting plan. You got to be there for 5 years in order for you to keep all the money that they've given you over that 5 years in your 401k if you decide to leave early. In the 401k, you cannot discriminate on a qualified plan. Everyone must be eligible for this plan that works there. Okay. So when you do this, because you cannot discriminate, whatever you offer to one person, you have to offer to everybody. We're going to get into other plans like non-qualified accounts where they can actually discriminate against you and all that. So right here, this is a T-bar. We're going to write, I want you to write this out completely because this is going to break down the differences between all accounts. So non-qualified contributions are currently taxed, not are tax deductible. So if you contribute to a non-qualified account, I'm sorry, to a qualified account, you can deduct that money from your income so it's not taxed. So you can lower your income for the year on paper. Non-qualified accounts, contributions are not tax deductible. So whatever you put into it, you still got to pay taxes on it. Qualified plans are approved by the IRS. Non-qualified does not need to get approved by the IRS. Again, they do not have the same tax benefits. They do have their benefits, but there's no tax benefits on them. So I talked about this. Qualified accounts, Gia, they can discriminate against, they cannot discriminate against you. A non-qualified account can discriminate. So I'll give an example of a discrimination per se would be, let's just say that you have stock options and you want to only give bonuses to the executives or the C-suite, higher management, and the other employees. Thank you for doing your job. Showed up. Here's your check. But you're not going to, in that example, could be. Obviously, these two are the same. Earnings grow tax deferred. Earnings grow tax deferred. So that's good to know. All withdrawals are taxed. Excess over cost basis will be taxed. We'll cover a little bit more in detail what excess over cost basis means, but just kind of write that out for yourself. Okay, any questions on this? Nope. Okay. So now we're going to go into the type of retirement accounts. This right here is going to get lengthy. So just be ready to write for IRAs. So there's two types of IRAs. There's something called traditional and there's called Roth IRAs. So let's talk about the differences. An individual retirement account requires earned income. That's the first word we wrote down in the definitions. Earned income is money that you earn through wages, salaries, or commissions. So in the this is a qualified account. In this traditional IRA, you can make tax deductible contributions regardless of age. So somebody can start this account at 18 years old, and if you contribute to it, it lowers your tax bill because you put money into this account. So it says participants are allowed to contribute a specified dollar amount each year. The number today, hey Siri, what are the IRA contribution limits in 2025?
Would you like me to use ChatGPT?
Sure, use ChatGPT. It's my best friend. I want to say it's 6,000.
25.
Oh.
To set the IRA
So-
contribution limit at $7,000 for individuals under.
Okay, so the IRA contribution limits for 2025 is $7,000. That's a big deal. You want to know what that means? Then there's something called, if you're over 50, it's something called the catch-up period or catch-up contributions. It's 85. No, yeah. See, it's always $1,000 more IRA contribution limits. Yeah, it's $8,000. Okay. So 7,000 for under 50. If you're 50 and above, you could put $8,000 a year into that policy. Or sorry, into that investment. Now, the one thing about IRAs is traditional IRAs, they're a older model of investment vehicles. So they have what is called a RMD, which is a requirement distribution amount. So I want to read this. In traditional IRAs, the owner may withdraw funds at any time. However, if they pull out before 59 and a half, the IRS will hit you with a 10% tax penalty. So that's all qualified accounts. If you pull out before 59 and a half, you will get penalized 10% of your money. Okay. So when you look at that, that is to help you almost deviate you to want to like incentivize you to not touch the money. There's a contribution limit because that's just what it is. You're not allowed to put X amount of money. Why is there? I don't know. That's just what it is. But there are other investment vehicles you could put more than that away, and we're going to talk about that. Everyone that's middle income families need to have a Roth IRA. And I'm going to cover that here shortly. But the traditional IRA, at age 73, you must start receiving distributions. You must start receiving money. Because if you do not start pulling out before 73, they're going to start penalizing your account. The reason this account has that is because back in the day, again, this is one of the older accounts. The IRS needs the money. They're going to tax you. So when you start withdrawing your money, that's how the IRS starts, again, giving Teresa a job, employing people like her to do your taxes. That right there is a taxable event for the government to bring in.
Guess what, Miguel? This past tax year, I did a lot of retirement returns, and a lot of people wind up cashing out their IRAs to help make up for the increase in property taxes, rent, and all of that stuff. Not all of it, but portions of it.
Nope, I don't doubt it. I think everything's so expensive these days. I mean, hey, look, that's the reason we're here today. Make some extra money, right? Okay. So now let's talk about hold on, did I just totally skip Roth IRAs? Wow, I totally did. So Roth IRAs. This is after tax contributions. So your traditional IRAs, your Roth IRA, and so your 401ks, the money's invested before it's taxed. The Roth, you've already paid taxes on the money, then you invest it. So now, Gia, all the growth in that account is tax free. This is why everybody should be having a Roth IRA. I don't care if you're putting $50 a month all the way to $583 a month, which will allow you to max out your IRA for the year. Because we believe if you don't save little money when you're making little money, you'll never save big money when you're making big money. It's the money habits that we're building here. What are you asking, Gia?
Okay, so you said the money is taxed first and then
Yeah, so you get a paycheck. You get paid, it goes to your checking account. By the time it's got to your checking account, it's already taxed. So then you invest it at that point. So it goes from your check to your checking account, then it's invested. The motion between your check to your checking account, it's already been taxed for the Roth. So now the growth is the ability to get tax-free advantages. The 401k, it goes from before it touches your check directly to invested. So now that's called pre-tax money. That's why the Roth is called after-tax contributions.
okay, so the Roth IRA, these IRAs, hold on, the traditional and Roth IRA is something that you have to invest yourself. Because I see the 401k is already just taken out of your check and put into another account. But for the traditional and the Roth IRA, are these just like you have to?
It
Go ahead.
depends on your employer. Your employer might offer a Roth IRA, and is that if they have it set up, it'll still be taxed the exact same way. Okay, so so this is a benefit of a Roth IRA. If Roth IRA accounts are open for at least 5 years, they have certain benefits that you can use that money for, and it not be only used for retirement. So when you look at retirement accounts, some people say, well, what if I need that money sometime before then? Can I pull out of it? Yes. It's your money. You can do whatever you want to do with the money. The beauty of a Roth is that you can take out whatever you want up to the amount that you put in with no penalty. So if you put in $1,000 and it grew to 1,500, you can still pull that $1,000 out with no penalty and leave that 500 in there.
Oh, you know, my mic was still on. My bad. So okay, so only the traditional IRA is the one that will actually have the 10% tax if it's taken out before you're 59 and a half.
No, all qualified accounts do that. I'm speaking on contributions and a Roth. If you pull out before 59 and a half on a Roth, they're only going to tax you 10% of whatever the interest has been earned. So if you pulled out, let's just say the account's 1,500 again, you closed out all the money, you're going to get taxed 10% of the 500, which is $50. Pretty straightforward. Now, these are the benefits of a Roth IRA. You can actually use some of that money for other events in life. Boom, boom, boom. Let me see if I can find them. Okay. They're not right here. Okay, yes, they are. These are the benefits of a Roth IRA. So you can take a portion of the money and use it for a first time down payment for a house up to $10,000. So let's just say you had a Roth IRA, it's got 20 grand in there. You could take 10,000 of that and use it as the down payment for a home. And there's no penalty on your money. If you become totally disabled, God forbid that happens, you can touch the money. You can use a portion of the money to pay for secondary post-secondary expenses. And then withdrawals are for catastrophic medical expenses or upon death. So it has flexibility there. But again, the money is meant for you to keep it there for a long time. Okay. You remember the word when I said we're going to cover the word excess cost basis? So in an IRA, if you put in more than that 7,000 or 8,000 a year, you're going to get taxed 6% a year on the excess that remains in the account. So excess contributions will be taxed at 6%. Any questions on this? So that 6% tax penalty, that applies to Roth IRAs and traditional. Those contribution limits apply to Roth and traditional IRAs. Okay. I pretty much gave you all this right here. I mean, I kind of just told you what it was. But again, you could come back and rewrite this down, but I gave it to you in bullet points already. Okay, let's talk about rollovers. Remember, if you leave a job, never leave the money at your old jobs. Anything can happen. HR directors can change. All of a sudden, you can't find your login info, and you said, "Oh, I know I got an accountant out there somewhere," and it's hard to find that money, right? The reason you want to keep this money together is that when you are putting your 401k into a new account, it's actively managed by other individuals watching your money. You don't want to just leave your money sitting out there. So a rollover is a tax-free distribution. All that means is you're switching it from one qualified account to the next. So has anyone ever heard of someone cashing out their 401k? If you've never heard of it, I will. I'll tell you how it
Yes.
works.
Yes, I have.
So if you have a 401k and you cash out on the plan and you're below 59 and a half, they're going to hit you with that first 10%, but they're also going to withhold another 20% for taxes. So if you had $1,000 sitting in that 401k or $10,000, they're taking 30%. I can tell you, if you can avoid cashing out your 401k, it's a hefty fee. It's 30% they take from you. I know if you have $300 doesn't sound too bad, but when you have 10,000, 3,000 sounds a little bit worse, or such and such, right? So the question is, how do you roll over your money? You get with an investment advisor, or you get with your HR director at your new job, and you say, listen, I have a 401k. I want to transfer it over here. Most of the time they handle all the paperwork. It's behind the scenes. It gets over there. Sometimes the check is actually mailed to the client, and then they got to bring in the check to us. But when you do a direct transfer, there is no tax implication, so you won't owe any money. But we do want to know this. If you do what is called a rollover and they send you the check and you don't deposit that money in 60 days, they're going to act as if you consider you cashed it out, and you're going to owe that 20%. They're going to send you a 1099 for that. So don't think because you filled out the paperwork, they sent you the check. You're like, hey, I did my paperwork. No, if that money's not in that account, they're going to consider that a direct payout, and they're going to send you that 1099. Okay. Any questions on IRAs? No? Okay. Very straightforward. All right. Let's talk about plans for employers. Let me see if I can rank this out. Okay. Hopefully we can go directly to this T-bar, and I'm going to add some things here. Look at you getting all comfortable. All right, so let's talk about this. Let's draw out this T-bar right here of the type of plans we have. And I will explain these individually as we write these out. So y'all need to stretch your hands a little bit. Hands getting cramped up, getting arthritis, getting, what's that? You type too much. Let's talk about the first carpal tunnel. Yeah, it's that one right there. See? So Keogh plans or HR10. These are for self-employed individuals. I want you to write the word Keogh and HR10 self-employed. That 10% or that HR10 stands for 10% ownership of the business. The self-employed individual can fund their own plan. So this is like a small employer that's to say, listen, I have some business partners that want to start in a retirement account. You can set up a Keogh plan and they can start funding their account on their own. This is generally not a matching account like a 401k, but in order to participate in this account, you must have 10% ownership of the business. That's all you need to know about Keogh plans or HR10. Okay, so the next one is called SEP. SEP stands for Simplified Employee Pension Plan. Let me just kind of come to that right there. Simplified Employee Pension Plan. Again, this is for small business owners. The primary difference between a SEP and an IRA is that there's much larger contribution limits. So let me give you, this is super cool. A SEP, it can also be known as what is called a SEP IRA. if you make a large amount of money, after you have funded your Roth, you can do this one. You could put up to 25% of your income away and knock that off your taxes. This is a qualified plan. Put 25% away. I want to say that the contributions limits are probably like 67,000 a year. Hey Siri, what are the SEP IRA contribution limits for 2025?
Would you like me to use ChatGPT?
Yes, use ChatGPT. Do Androids have ChatGPT over there?
25. The IRS has set the IRA contribution limit at $7,000 for individuals under 50, with
Oh.
$1,000 cap contribution for those 50 and older, totaling $8,000. Roth IRA eligibility depends on your modified adjusted gross.
Okay, you answering it, but without answering it. So SEP IRA contribution limits for 2025 is $70,000. So imagine if you made a good amount of money, obviously you got to make. Hey Siri, what's 25% of, no, I don't even know the answer. I'm about to ask, whatever. So, up to $70,000, you could deduct off your income, but it has got to be 25%, or 25%. That is a really great account. Who can contribute to that? Employers only. So employers can contribute to this. You can set up a SEP IRA individually. You don't need an employer to do that. The next one is called Simple. I don't really see these a lot, but they might on the exam. A simple plan is saving match incentive plan for employees. This is available to small business owners who employ no more than 100 employees, who receive at least 5,000 in compensation from their employer from the previous year. To establish a simple plan, the employer must not have a qualified plan already. Okay, so you can't even have a 401k plan already in place. Employees who elect to participate may defer up to a specified amount each year, and the employer makes matching contributions dollar for dollar. So, okay, so this is a plan just like a 401k plan. Let's go here. I think the next one is called our 401k plan. All right, so let's talk about 401k or profit sharing. The reason it is called a 401k plan is because that's what it's called under the tax code. Only thing you need to know about a 401k is that it's called an employer sponsored plan. The money grows tax deferred. When the employer contributes to it, that is a tax deduction to the company. You can take out a loan on your 401k up to a certain amount. When you pay back the loan, you're paying yourself back in that situation. And there are contribution limits in a 401k. It's hey, no, I'm not even freaking ask Siri no more. 401k contribution limits. Contribution limits for a 401k is now, with the employer contributions, is 70,000. Wow, that's a lot. Hey, catch it. Wow, yeah, you can, if you're under 50, you can contribute up to 23,500 in your 401k. That's a lot. And that's really good. All right, the last one I believe is called a 403b. So 403b, tax sheltered annuity, TSA. 3 different words, all mean the exact same thing. Has anyone ever been a teacher or a nurse or worked in a like a school system or something like that? If you have, you would have what is called a 403b. A 403B is nothing more than the nonprofit organization, nurse, teachers version of a 401k. They all mean the exact same thing, except the only people that can contribute into a 403B are people who work for nonprofit organizations or school systems. Most of the time, if you're a nurse, you have a 401k, but if you're a what's the word I'm looking for? A nun, you'd probably be working for a nonprofit organization or a church. You'd have a 403B with them. And these are all qualified accounts, so they cannot discriminate. All the money goes tax deferred. And if you pull out before 59 and a half, they will hit you with a 10% tax penalty. Okay. Any questions on this? If you got that down, that's all you need to know about retirement accounts. We just simplified that entire thing right there. Okay, last 3 ones. We're almost done. All right, this one's gonna go by pretty fast. So these are the need for life insurance. What are the actual needs for life insurance? The first one is called survivor protection. Hey, if you got a spouse, guess what? You probably want to help your spouse survive. So survivor protection. I sat down with men and husband and wives. The husband to say, "Why would I buy life insurance? She gonna marry somebody. She gonna marry somebody else new." I'm like, "Why are you still married to this guy? Obviously, he don't care about you. Take care of you while you're alive, but not when you die." Maybe I'm a man, too much of a man's man. I think a man should take care of the woman, even if you have an Android.
You are right. Your thinking is right.
I know people progressive these days. I don't need no man. Well, cash accumulation. How would life insurance help out? Well, cash accumulation is if you have a whole life policy, that happens. Man, oh man, I've got a story to share with y'all today about a policy that I broke down. Oh my gosh, it was crazy. Cash accumulation. So if you have a cash value policy and you build a savings, it will build savings eventually that you can borrow from. The word liquidity, I want you to write the word right there. Liquidity means money that can be borrowed against the policy. You will see that on the exam, and it is such an easy question to get right. They'll say, in which of the scenarios would life insurance have a liquidity event? It's money that can be borrowed from the cash value. Remember, cash value is only attached to whole life policies, not term. Okay. Okay. The next one is estate creation. I want you to write life insurance creates an immediate estate right under estate creation. Now, let me explain to you what that means. Most people that we're sitting with might not have any type of assets. But the moment they get a $300,000 life insurance policy, they create an immediate estate if they pass away. So that is the reason most people would get that. It's called estate creation. It takes care of any things like that. The last one is called estate conservation. There are people who have a lot of assets. And you know what assets come with? And you pass away? Comes with inheritance tax and federal taxes. So in order for the beneficiaries to not have to sell their profit or their properties, use life insurance proceeds to pay the taxes. If you ever sit down with a client and they say, well, I don't feel like I really need life insurance. I have 3 properties. The family will get that. That's even more of a need for life insurance. Because guess what? That family's going to inherit the properties. If they don't have the money to pay the property tax, guess what? They lose the properties anyways, right? If they can't upkeep the properties, they can't pay the inheritance tax, they can lose everything. More of a need to have life insurance. So those are all the personal reasons someone would need life insurance. Does anybody have any comments or questions on that one specifically? No? Okay. So here are the business reasons if you have small business owner friends, they all need life insurance. And I'm going to share with you why. I always ask a question, Gia. Hey, so-and-so, Mr. or Mrs. Business Owner, you have your business, you've worked hard to build it. If God forbid something happened to you, do you want the business to die with you? Or would you want it to keep it going? And they're going to say, well, I want it to keep it going. Well, if something happens, if you're the one running the business, don't you think there's going to be new expenses incurred, new payroll to train someone to take over? If you were the main producer of income, now you're going to lose loss of funds. Or what if you had business partners together? So Gia, let's just say you and I go into business together. We both own 50-50 a part of a restaurant. If God forbid one of us passed away, now my family has inherited 50% of this restaurant. My family ain't ever been involved in one day of the restaurant business. You don't want them coming in the business trying to take over and try to add to the business or take away, right? So you take out a life insurance policy out of me, I take out one on you. And that money you take out, you say, no, family, keep your ass over there. This restaurant's mine now. We don't need you messing this up. That make sense? Now, what happens if you and I still have this policy together and the business dissolves and you keep paying the premiums on it? And God forbid someone passes away. Who do you think gets the money? You or the family? I don't know what you're saying. I can't think. I'm trying.
The person that you were in business with.
Correct. So maybe you want to go into business with a bunch of people. Not telling you to go do that for the sole purpose of buying insurance on each other due to compliance. I cannot agree with that. But so if you go out there and we talk about those examples, there is something called key person insurance. Actually, if you're a pastor of a church, the church generally has a policy on you. I learned this because I recruited some pastors well over a decade ago, and they gave me the rundown on the church business. So if the main pastor is the one running the business, if he passes away, don't you think that it's going to go through a new leadership transition? Some people might leave the church. What if he was handling the day-to-day business? So they take out a policy out on the pastor, and that would be a key person because he runs the business. Whether you want to call church a business or not, it runs like a business, and it better run like a business because the Bible talks about money a lot, right? So we have to be stewards of our money. So the pastor would be a key employee. Now, who's the beneficiary? Who's the policy owner? The church. The church is paying the premiums. The church is the beneficiary, not the family. Because the key person is that individual. Now, I want to make a key note here. Key person insurance may be used by any type of insurance. It doesn't have to be only term. It doesn't have to be only permanent, whole life, or universal. It can be any type of insurance. Okay. So any questions on that? I'm just saying, if your husband's a pastor or a bishop, not saying he needs $1 million of coverage extra that we just wrote on him, or maybe 2 million. I don't know. Maybe he can hear me in the background saying, "Hey." So key person, who would be an employee or key person employee? It would be someone that if they passed away, the business would have a big financial loss. And you would need that money to either keep the business going, to hire the replacements, or maybe even just to keep paying the bills while you're trying to generate new revenue because you got to fulfill that new position, right?
Miguel,
Yes.
on the key man insurance, would that be a say the scenario with the church? That wouldn't conflict with oh God, the will or the trust of that individual?
No, because the insurance policy is not owned by you.
Got it.
It's owned by the church.
Got it.
Yeah.
Got it. Okay.
Remember, you can have as many life insurance policies out on yourself as you want.
Okay.
So, not saying Mr. Gamble needs $15 million of insurance, but
Yes, he do. Yes, he do.
every wife won't say that. All right.
Yes, he do. The reason why I bring it up because there is a couple situations with some mega churches in Jacksonville where the pastor did pass away, and it was a dispute between the key man, the insurance the church had on the pastor versus the pastor willed because it was interconnected some kind of way, and I thought that was weird to have his personal personhood connected to what the key man insurance for the church. So because it is, the church is sitting empty.
Well,
That's all I'm saying.
it's called a building now. The church is the people. The building is empty, but not the.
That's what I meant. The building is empty. Yes, correct.
All right. So, now remember, Gio, back to the conversation we had that we're business owners. We're in business together. The contract that we use is called a buy-sell agreement. So a buy-sell agreement is a legal contract that you and I sign. If God forbid something happens, that's what we're doing with the money. But it's funded with life insurance. Remember, if you're ever doing business with somebody, it better be in writing. We need to get everything in writing because things happen, right?
So Miguel, so that means if they screw up, can I get errors and omission insurance on that person I'm doing business with?
I don't know. Maybe might want to talk to Arizona Miss Insurance agent. And maybe if they own this, if they're watching this on YouTube, they should follow me on Instagram right here and message me right quick.
Got it.
Our team. All right. So let's talk about this. Okay. I don't completely remember all these definitions, but we're going to read over these. Okay. So there are several reasons for buy-sell agreements that can be used for partnerships or organizations. First one is cross purchase, where used by business partners buy policies on each other. That's the first one I spoke about. Entity purchase, when a partnership buys policies on the partners. So now the businesses bought the insurance on each other. Cross purchase is Gia and Camille and I, we're all three in business together. I'm buying a policy on each of you. You're buying a policy on each of us, Gia, and then Camille, you'd buy one on one of Gia and I. If that ever happens, I want to be the agent writing that. That's like 6 policies you're gonna write right there. So that'd be dope. Stock purchase, used by privately owned corporations when each stakeholder buys a policy on each other, and stock redemptions. Used by privately owned corporations when each stockholder buys a policy on each other. Okay. I don't know what scenario that would come into place, but let's Let's see. Nope. And then stock redemption is when a corporation buys one policy on each shareholder. Okay. Any questions on that? Nope. Okay. Let's move on to the
I'm
license.
still writing that. Hold on.
Thank you. Thank you for saying something.
Miguel, on the stock purchase and the stock redemption on those corporations, does that mean the board members? So can a corporation buy insurance for their board members?
I honestly don't really know when this would come into play.
Okay,
I've never encountered it, so it's like not even a thing that I, for the sake of the exam, just know what it says and
got it.
hopefully get the answer right.
Okay.
Okay. Are we good to move on to the next part, or you still writing? We're good? All right. We're almost done, y'all. So tax treatment on insurance premiums. Boom, 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 boom. Why is it so long? Golly. Let me some of this is gonna repeat what we've already done. Yeah, okay. So premiums are not tax deductible, meaning if you have an insurance policy on yourself, you can't say, okay, let me write this off my taxes. Death benefit. If you get a death benefit from an insurance policy, all the money's tax free. The whole check is tax free. So if you get a death benefit from an insurance company and it's tax free, the moment you invest it and the moment that thing starts earning interest, you're going to pay taxes on that now. Remember, anytime you've earned interest, it is taxable. Okay. So the next one, we've already talked about this. Dividends are not taxable because they're just a return of premium. Cash value accumulation. If you have cash value in your policy and you borrow from it, it is a tax-free loan. There's still interest to pay on it, but you don't owe any taxes on it. But if you cancel your policy, you cash surrender it, and you have any extra money sitting in the policy. So give you an example again. If you have a whole life policy, cash value of $10,000, and you've only paid $8,000 into it, there's a $2,000 difference in profit. You are going to owe taxes on the growth as ordinary income. You want to know that your tax is ordinary income on cash accumulation. Cash surrender, again, if you I kind of actually just said that right there, what I just said. Okay. So you remember we talked about you could sell your policy. There are times where if you have let's give an example, a terminal illness rider, they'll have what are called accelerated benefits. Let's just say your face amount is 300,000. You've paid in 70,000. You have a cash value policy of 100 grand. If the policy surrendered for $30,000 of cash value, the full $30,000 will be tax free because you've overpaid into the policy. So accelerated death benefit. In this example, if you get money up front due to being terminally ill, the benefits are tax-free. So if you have a $200,000 policy and you get $100,000 advance to you, that check is tax-free. Now, when would you have a terminal illness or accelerated benefits? For example, if someone has cancer, Alzheimer's, whatever, disease or severe illnesses, these benefits are tax-free up to a certain limit. Any amount that's received in excess to the dollar limit must be included in the gross insured's income. I don't know the limit. They don't really quiz us on that limit, but just kind of know that idea. I just mentioned this, life insurance proceeds named to the beneficiary are tax-free from the federal government. So if you have $1 million policy and your family inherits that, they're going to get $1 million tax-free unless, remember what I said here, if you invest the money and it does what is called transfer for value. Meaning the life insurance policy is sold to another company prior to the insured's death. So that money could be taxable to them. All right. Settlement options. We covered settlement options yesterday. Cliff, C-L-I-F-F. You need to go back and rewatch chapter 3. Go back and rewatch that. And then this right here is, Camille, is again, another tax T-bar. If you didn't write this down, you can. I can leave this here for a second. You let me know. You guys want to let me leave this here and let you write this out? Okay, cool. Well, leave that there. Wow. All right, y'all let me know when I'm good to move on. Mhm. Chug, chug, chug. Am I good to move on? Are you guys still writing? If you're still writing, we can always come back. Okay, let's move on to the next one. All right, so group life insurance. We already talked about this. It's tax deductible to the employer. Okay, this is again, a lot of this is repetition. Okay, this right here, we do want to know this. Modified endowment contracts. These are known what are called MECs. A MEC is simply an insurance policy that you are allowed to fund the policy a lot to let the cash value grow. But there's something called the 7-pay test. That if the cash value grows too much, it will lose its benefits. So it will fail the 7-year pay test. And you'll lose all the benefits that it was supposed to be used for. So just a MEC is called modified endowment contract. It fails the 7-year pay test. And one thing is, once a MEC, always a MEC. So if your policy, you overfunded it and it grew too big, you cannot reverse it. That was kind of a rule that the IRS put intact to kind of guide or regulate the insurance industry somewhat. Okay. I will let you come back to read this on your own. Chapter 4, section F. It kind of gives you all the things we talked about, things I've already talked about when it comes to tax deductions, personal expense. Let's wrap up the last part of this. Social Security. So Social Security works in 2 different ways. There's Social Security for disabled, and there's Social Security for retirement. The real word for Social Security is called Old Age Survivor Disability Insurance. I don't know if you know this, but Social Security is supposed to be drained by 2034. So if you my age or younger, please, though, none of us ain't nowhere near daggum retirement age. Y'all ain't getting no Social Security. You're going to keep paying into it, but you ain't going to get it. So Social Security is set up in a couple ways. So the terminology we want to know is fully insured. 40 quarters of coverage or 10 years of work. They're not going to quiz you a lot on the details of this, but we just want to know these terminologies. Social Security is fully insured or 40 quarters. I think like full-time 40 hours. I don't know why I think that way when I see that, or at least 10 years of work. They're going to receive the full benefits of their Social Security. Then there's called currently status or partially insured. You must have 6 credits or 13 quarters. 6 credits, 13 quarters. Full status is 40 quarters and 10 years of service. Okay. Again, there's a T-bar right here that I encourage you to come back and read, come back and go to chapter 4 for yourself and read this, but it's pretty straightforward. This is what survivor benefits are. There's a couple things we want to know here. Dun, 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 dun. There's something called the blackout period. You want to know this because you will see it. This right here says once a minor reaches the age of 16 or the parent is no longer eligible for retirement again until they're not longer eligible for Social Security retirement benefits until 60 years old. That is called the blackout period. You will see that on the exam. There's something that there is not shown in here, but it needs to be said. Social Security disability ends at 64. No, it ends at 65. So Social Security for disability ends at 65. Social Security for retirement begins at 65. So essentially, if one ends, the other begins for that individual, if that happens. Okay, and recapping this, I would encourage you to come back to chapter recap. Everything that we went over is right here. These are good little study guides to print out for your kind of like your fact sheets for you to remember. You guys want to take a quiz real quick? See how we do? Cool, let's do it. Okay, an employee is insured under her employer's group life plan. If she terminates her coverage, which of the following is incorrect? So remember, when this says incorrect, you're looking for the wrong answer. So just always be on the lookout for these things. The insured may convert coverage to an individual plan within 30 days. The premium,
D.
D, the
Go.
insured would need to prove insurability, would not need to.
Oh, wait, it says not. No, it's not D then.
Double negative. Nope. Try to confuse us. The insured may choose to convert to term or permanent.
Oh,
Remember,
it's C. They can only have permanent.
there
It's
you
C.
go. Good. When you convert from group,
Let's see. They can only have permanent because the employer chooses, and it has to be permanent.
now remember, when you have group insurance, it's annually renewable term policy. But if you if you leave your job and convert, it's a permanent policy. All right. So chapter 2 or question 2. What if a life insurance policy develops cash value faster than the 7-year pay test? What is that called?
C.
A Mac. C.
Go. There you go. Told you you're gonna see it. And you got it. Come on. So after any cash value policy that develops cash value faster than the 7-year pay contract is a modified endowment contract, which loses its benefits of a standard life contract. All right. If $100,000 life insurance proceeds were used in a settlement option, which paid out $13,000 a year for 10 years, which of the following would be taxable annually? So now that transferred value, remember that. So what answer are we going with? Let's see. D. Okay, the 13,000.
B.
So, okay, Camille said B.
I said B too.
Okay, and Gia said B. So why would we say B over D?
Because it's only going to be the interest on the payment amount.
Mic drop. Boom. Good job. It's only the interest that is taxed. The 10,000 was going to get paid out either way. It's just the interest that is earned over that. That would be good. Good job. Okay. In terms of Social Security, what is the interval spanning between the day when the youngest child of the family turns 16 before the surviving spouse turns 60? Aren't you glad we just we blocked out all the other crap we didn't need to read and bam, it's right there. Blackout period. Good job, y'all. Okay, which of the following is true regarding taxations of dividends and participating policies? Is true. Which of the following is true? A. Love. Everyone says this. Dividends and in life insurance are not taxable because they are just a return of
Premium that are being returned.
the insurance company overcharged you and they're giving you your money back. Remember, dividends are not taxable. They're just a return of unused premium. They are not guaranteed. So good. All right. Two attorneys operate their practice as a partnership. They want to start a program throughout their practice that will provide retirement benefits for themselves and their 3 employees. They would likely choose what?
B.
B. Okay, you said the Keogh plan? It could be the Keogh plan because it's it could be B, it could be C. It definitely would not be 403B because they're lawyers, they're not.
Nonprofit.
Yep. So what do we want to go with? We want to go with B or C? I think more people are leaning towards B, right? B. All right. I want to say it's C, but I'm hoping I'm wrong. I was wrong. Good job, ladies. Good job. Don't let me second guess you. They say y'all have your intuition for a reason, right? I just hope you guys get some intuition and get rid of the Android. All right. So 403B plan, commonly referred to TSA, is available, also used for.
A.
It is definitely A. TSA 403Bs are used for your teachers, your nonprofit organizations. Government workers would generally, no, they're going to have a 401k plan. So tax sheltered annuities, commonly known as 403B plans, are designed for teachers and nonprofit organizations. So good. Okay. Who is the owner and who is the beneficiary of a key person life insurance policy? Who's the owner and who's the beneficiary? Let's read that again. Who's the owner of the key person policy? The policy is on the key employee, but who is the benefit if that person passed away?
Still the owner.
It would be the
Lawyer. C.
C. I think you would have got that one, Camille. I think you just read it a little too fast. You saw that. I'm watching. Yeah, so it would be C because the owner is the employer. Remember, a key person policy only comes from the employer buying it or the business buying it on the employee. Okay. So an employee quits her job where she has a balance of $10,000 in her qualified plan. If she decides to do a direct transfer from her plan to a traditional IRA, how much will be transferred from one plan administrator to another, and what is the tax sequence for a direct transfer? Okay, Teresa saying B.
B.
Okay. Everyone's saying B. Good. That is true because it is from one company to the next. The employee or is not getting the money themselves. So good. All of the following are examples of third-party ownership of life insurance policies, except An insured couple purchases life insurance policies insuring the life of their grandson. That would be a third party. When an insured purchases a new home, the insured makes an absolute assignment policy to the mortgage company. Okay. A company purchases a life insurance policy on their manager, who is an important part of their operation. That would be third party.
E.
I think
Wouldn't more be like credit, not third party?
well, D says an insured borrows money from the bank, makes a collateral assignment, and part of the transfers it. So everyone is, oh, whoa, we got a couple different answers. Teresa, you said A. Camille and Gia said B.
I think it's D.
So
D
all of
would
the,
be a credit life, but I think credit life is not a third party, is it?
well, remember this. Third party is someone who owns the policy. So a grandparent owning a policy on the grandchild, third party.
Mm-hmm.
C, a company owning the policy on their manager, third party. An insured borrows money from the bank and now gives them part ownership of the company of the policy, third party. B says when the insured purchased a new home, the insured made an absolute assignment policy for the mortgage company. So it's either between B or D. The only thing that's got me tripped up here is that generally an absolute assignment is not meant for a mortgage company. It would be generally meant for forgive me, let me not even let my brain go to thinking here because I might be out thinking myself. It's either between B or D. What do we want to go with? I'm leaning D is the answer.
I
Now,
said D too.
I think you're right, Jamal. Let's try it. And there we go. So let's read it. Collateral assignment is transfer of ownership of some or all death benefits of the policy as a creditor as to secure the loan, but does not give the creditor ownership of the policy. In the event if the insured's death, the creditor would only be able to recover the portion of the policy proceeds equal to the creditor's remaining interest in the loan. All right. All right. If a retirement plan or annuity is qualified, this means what? Easy answer. Easy answer. D. Yep. And this is an easy one to get right. Qualified has to be approved by the IRS. So yeah, absolutely right. All right, almost done here. All of the following statements are true regarding group insurance, except small groups such as a labor union are eligible for group insurance. The group sponsor is the policy holder. Participants in each of the policy receive a policy. Participants in the group plan are issued certificates of insurance. So it said all the following except you were looking for the wrong answer.
C.
You are absolutely correct. Participants receive a certificate of insurance. The employer receives the master copy or master contract. So good job. Good job. Okay. An insured has a modified endowment contract. He wants to withdraw some of the money in order to pay medical bills. Which of the following is true? He will have to pay a penalty. He will have to pay a penalty if he is younger than 59 and a half. He will not have to pay a penalty regardless of his age. He cannot withdraw the money from his MEC because before 59 and a half. So remember, this initially was a life insurance policy. They overfunded it and it grew too fast. So the life insurance company, or so the IRS now classifies this as a MEC. So it does not get the certain tax benefits of a life insurance policy or qualified accounts. So we're going D, or are we going A or C? What are we going with? Might as well just throw B in there too.
Let's say
I don't know. I don't know this one, so we're gonna figure this out together. C. Can we get a unanimous vote? So
A, he's gonna have a penalty regardless of age.
all right. G is like, man, I told y'all this. Why else? All right, let's go A. Answer was B.
Oops.
So let's read this right here. All right, any cash value policy that develops cash value faster than the 7-year pay whole life contract is called a modified endowment contract. It loses its standard life contract. All withdrawals are based off of LIFO, which is last in, first out basis, and withdrawals are made for 459.5. There's a 10% tax penalty. Okay, that's something that we know now. MEC, MEX, they have that 10% tax penalty also. Don't know why, who cares? Just know what it means, so we pass it on the exam. Okay. Next one. All of the following would be eligible for the establishment of a Keogh plan, except
D.
D. Okay. Again, it doesn't look like we're unanimous over here. We have A, C, and now we have B, and then we have D, and then might as well throw E in there. You just all of them, all the above, right? All the following except you're looking for the wrong answer. So establish who can get a SEP. I'm sorry, a Keogh plan. Remember, small business owners has to have some ownership of the business. B, okay. C. I don't want to give it to you. I want y'all to actually like be able to do some research on this one. That's why I don't want to just give it to you. You only got 2 questions left. Camille, what you got? Okay. Let's go C. Let's see what happens. I think we've done enough to pass it either way. Don't second guess yourself. C for Camille. That's what it was. All right. Keogh plans are for self-employed individuals and their employees. All right.
Okay, so I don't understand.
What-
Okay, so if it's for individuals and their employees, wouldn't someone with no employees be eliminated? It
that
said,
one, the rest of them were self-employed. The C said he's the president and an employee, but he's not self-employed.
Yeah, no, he's an employee.
but D said they don't have any employees, so they wouldn't be eligible, correct?
No, because you can be an employee. You're self-employed. Remember, Keogh stands for self-employed. If you go to see who says who contributes, self-employed.
It says self-employed and their employees. So the sole proprietor would be self-employed and then no employees. So they cover the self-employed part, but with the no employees is what got me. So it'll be them. So because they're sole proprietor, they would be eligible, even though they don't have anyone else.
Correct.
Mhm.
Okay. So it can be just them. As long as they're the owner. Got it. Doesn't have to be them and at least an employee.
Correct.
Got it.
Good. All right, last one, y'all. Which of the following is not true regarding non-qualified plans? It can discriminate. Earnings grow tax deferred. It needs IRS approval. Contributions. I think we're unanimous. C. Non-qualified does not need IRS approval. Guess what? Y'all passed with a 93. Good job. Y'all do that again, we'll be gonna freaking kill it. But that is chapter 4. Y'all did an awesome job tonight. Any questions on this so far? I think it's pretty straightforward, ain't it? Give me a second. Let me end this stream.